In exercise 7-6 and 7-7, we're going to look at two different ways of handling cash discounts. The first way is the gross method, and the second way is the net method. So we start off in 7-6 with Harwell Company manufactures automobile tires. On July 1st of 2021, the company sold 1,000 tires to Nixon Car Company for $50 each. The terms of the sale were 210 net 30. So that's abbreviated as 2 divided by 10, comma, N divided by 30, 210 net 30. And what that means is if you pay within 10 days, you get a 2% discount. Otherwise, the full amount is due within 30 days. And I'll show you after we do this problem how much of a interest rate that is. It puts credit cards to shame on when you calculate the interest rate on that. So Harrell uses the gross method of counting for cash entry for the cash discounts. So we prepare the journal entries for the sale on July 15th and the collection on July 23rd. And then part 2 is prepare the journal entry to record the sale on July 15th and the collection of August 15th. So we're going to show within the period and without the period. So the sale, July 15, so that'll be 7-15. We are going to have accounts receivable. And that will be for 1,000 times $50 is $50,000. And we're going to have sales revenue. And the problem told us to ignore the cost of goods sold, so we will do that here. So that's 7-15. Now, the collection of that account, if we do it within the 10 days, so on the 23rd, so 7/23, we would have the cash, and we've got to figure that amount. So it's 50,000. And we're going to get 98% of that, 2% discount. We're going to have $49,000 as a cash receipt. Now I'm going to skip a line here, and I'm going to write off the accounts receivable. And so that's $50,000. All right. So now we know enough by this point to know that our journal entries must always balance. So we've got 49 and we've got 50. So what's missing is that discount of $1,000 for paying within the 10-day period. So what we're going to do here is take sales discount of 1,000, and now we balance. All right. Now, before we go on and do the next part of this one, let's talk about what that discount represents. It is actually a contra sales revenue account. So it offsets the sales revenue. So if we were to report our revenue on our income statement, we would only report 49,000, not the whole 50,000. It is a contra revenue account. We keep it as a sales discount and don't just write off sales revenue so that we can keep track of how many people are taking discounts and various things like that. All right, so what happens if they don't pay until August 15th? In that case, we're going to receive the full amount of cash is going to be 50,000, and accounts receivable will be 50,000. And so the full accounts receivable, in either case, the full accounts receivable is written off, but they don't get a discount on that. All right, so in exercise 7-7, and by the way, that is known as the gross method. I'm recording the full receivable up here, the gross receivable. Now, in 7-7, they modify it. It's the exact same problem that we have before, except now we use the net method. So the net method means that is generally used when most people take the discount, or at least we know that a particular buyer will take the discount. And so instead of having to write off that sales discount, I just record the revenue at the amount that it's going to end up at. And so in that case, using the net method on 7-15, I'm going to have accounts receivable of $49,000. So the tire is $50 each. They bought 1,000. That's $50,000, but they get a 2% discount if they pay on time. And we know this customer pays on time, so we're just going to book it as if we're going to receive the $49,000, and then we'll have the sales revenue of $49,000. All right, so that would be the entry under the gross method. Then on the 23rd, if they pay within the discount period, our entry will be cash for $49,000, and we're going to write off the accounts receivable. For $49,000. Okay, so that works that way. And then let's say we go to the 15th, push that up a little bit. We go to the 15th. They don't, in case they don't pay on time, the journal entry on 8/15 would be cash, and this time it will be the full $50,000. I'm going to skip a line again. I'm going to write off the accounts receivable. And that'll be $49,000. And we know we have to balance, so it's the discount lost. And so that actually, we write it as sales discount lost for $1,000. And that will be, that sales discount lost is actually an extra revenue account. So that would be reported when we prepare our income statement. That would be netted with our sales revenue. So we'd have the sales revenue of $49,000 plus the sales discount of $1,000, sales discount lost of $1,000, and that would give us the $50,000 sales revenue. All right, so that's exercises 7-6 and 7-7.